In the mid-1800s, money could only move as fast as a horse. Prices traveled by steamship, profit by rail, and rumors on foot. A merchant in Boston could set a price for wheat using numbers that were already stale by the time the ink dried. A banker in Chicago might wait days for London-esque closing figures and then wager a month's business on whispers carried by the next train. Then a copper wire stretched across continents and snapped time in half. Overnight, markets didn't wait for the morning paper, they listened to electricity. A few years later, a humming drum of clockwork began spitting letters onto a narrow ribbon and turned information itself into a weapon. Real time was born, and with it, a new kind of power. Before the wire, markets moved at human speed. Geography wasn't background scenery, it was the market's most stubborn law. London's cotton prices might drift across the Atlantic, tucked inside the captain's strongbox, arriving breathless and outdated after days at sea. A price set in New Orleans could take a week to discipline a mill in Massachusetts. The ocean and the prairie were not just distances. They were delays that traders insured against as carefully as they insured against fire. Arbitrage existed, but it was physical. Buy here, ship there. Pray the world still looked the same when your cargo arrived. In that world, the edge belonged to patience, proximity, and luck. The butcher who knew the rail schedule, the clerk who had a cousin at the docks, the banker who read the market like weather because he had seen 20 harvests. These were the advantages that determined fortunes. The Telegraph changed all of that by erasing the tyranny of distance and replacing it with the discipline of code. Dots and dashes raced along wire faster than any ship could sail, and a price could leap from one city to another in minutes. That collapse of space did more than speed up trade. It changed what price meant. A price used to be an estimate that tried to survive the journey. Now it was a signal, a pulse, a heartbeat shared across multiple cities that began, for the first time, to live in the same moment. When time compresses, risk changes shape. A baker in Boston no longer worried that Chicago's quote was last week's news. He worried that New York would blink and move the market before his clerk finished reading the message. A grain dealer didn't need to ship as much to profit. Now he could trade the knowledge of where the ship should go. Information ceased to be a courier for goods and became a commodity in its own right. Priced, bought, sold, stolen, and guarded. Networks grew to feed the hunger. News agencies stitched together wires, rail depots, couriers, and briefly pigeons, just to shave seconds. Telegraph companies consolidated and sold leased lines to banks and brokerages so they could whisper in private. Exchanges paid for dedicated circuits to become the first receivers of the present. The public waited outside the glass, peering at clerks who stared into a future the rest of the city would learn a few minutes later. Real-time was born elite, and people paid handsomely to live even a sliver closer to it. Because when you knew the price before your competitor, you didn't just buy inventory, you bought his comfort, his planned margin, and sometimes his livelihood. But the Telegraph had a problem. It connected cities, not rooms. Price still needed a voice inside the broker's office, a way to turn electrical pulses into something you could see without a trained operator standing by. The solution was a mechanical miracle that shrank the wire S power into a hatbox the world could gather around. The stock ticker arrived not as a philosophy, but as a machine, a small iron and brass contraption whose chatter filled brokerage rooms with an urgent percussion. Inside, electromagnets pulled on levers, gears kept time, and letters inked their way onto a narrow paper ribbon that unspooled like a steady river. Symbols and numbers, compressed, standardized, and relentless, fell into the world second by second. No more waiting for a clerk to shout quotes across a crowded floor. No more pacing the street outside the exchange hoping for a whisper. The market's pulse now visited any room that rented a line. That little tape changed behavior. Company names were compressed into short symbols so the machine could keep up, and those abbreviations became the alphabet of a new language, the language of speed. Quotes arrived not as occasional bulletins, but as a continuous stream. The market stopped behaving like a series of declarations and started behaving like weather. Investors didn't read a report, they watched a sky. Brokerage offices, far from the exchange, became mini-theaters where customers gathered to read the ribbon as though it were scripture. A room with a ticker wasn't a room, it was a moment, freshly minted and sold at cost plus commission. And a new craft emerged, tape reading. Traders trained their eyes to notice rhythm, little surges in printing, stutters between symbols, gaps that hinted at imbalance. They cultivated a sixth sense for flow. Some of them made fortunes by listening, more of them paid tuition to the machine. Did the ticker democratize finance? That depends on which side of the counter you stood. For the first time, middle-class professionals could walk into a storefront in Omaha or Providence and see the same prices their wealthier cousins were seeing in lower Manhattan. Access widened, and the trading room's mystique leaked into the street. But hierarchy simply rearranged itself around a new scarcity. The person closest to the wire saw the future first. 5 minutes of delay turns real time into theater. Private circuits were smoother, better maintained, and less likely to fail during a rush. Premium customers got priority service and cleaner print. The new democracy came with velvet ropes. Wherever the promise of quick money gathers a crowd, a certain kind of business follows. Bucket shops rented tickers and let customers bet on price movements without ever sending orders to the exchange. You could walk in, slap cash on the counter, and wager on whether a symbol would rise or fall. The house often took the other side of the bet. As long as the average customer lost, and the average customer usually did, the ribbon would keep them hypnotized long enough to refill the drawer. It wasn't just vice. It was a feedback mechanism. The tape made watching addictive. Watching made betting tempting. Betting magnified volatility. Volatility made the tape more thrilling, and the cycle pulled in more wallets. Information had become spectacle, and spectacle had become a source of flow. Regulators eventually swatted many of these shops, but the habit remained. The public had learned to live inside the market's minute, and the minute liked the company. Speed brought clarity. It also brought synchrony. When everybody sees the same thing at almost the same time, reactions tend to line up. Optimism can rush through cities like an electrical storm. So can fear. Before the wire, a bank run was a local panic, a rumor that might die at the town line. With the ticker, a city could watch itself losing confidence in real time, and neighboring cities could watch the city watching itself. Selling wasn't hearsay anymore. It was a ribbon that printed lower and lower in your hand. The gap between fact and reaction narrowed to seconds, which made the market more efficient and more brittle. Systems that coordinate too well can fail together. The same wire that carried panic also carried reassurance. Central bankers and financiers learned to fight a narrative with a headline, to inject liquidity not just into banks, but into belief. A soothing statement could ride the same circuits as the fear it was meant to drown. Attention itself became a policy tool. Technology never arrives alone. It brings a new map of power and a fresh constitution for the market. Exchanges decided which companies earned symbols and which brokers earned seats. Telegraph companies controlled the pipes and rented access, like landlords rent sunlight in a narrow city. Dispatchers prioritized certain lines, repair crews favored certain customers, and the physics of relay stations quietly shaped the culture of money. Contracts, rules, and charters mattered, but infrastructure decided who lived in the present and who lived 5 minutes behind it. The story of markets is not just a story of prices, it is a story of pipes. People like to imagine finance as a frictionless abstraction where merit floats to the top. The telegraph and ticker proved otherwise. The rules were nailed into wooden poles and buried beneath cobblestones. The machine also rewired the human animal who used it. Before the ticker, investors studied balance sheets and quarterly reports as if they were charts for a long voyage. After the ticker, a second language layered itself on top of the old one, the language of motion. A string of prints could suggest appetite. A sudden gap could whisper of trapped orders. A burst of activity might hint at a stop-loss cascade. Quiet could feel like coiled energy, ready to spring. Traders began to describe price the way hunters describe wind, or sailors describe tide. The best were not mystics. They were pattern recognizers trained by constant, merciless feedback. The ribbon taught discipline by burning anyone who believed too quickly, and rewarded those who understood that a stream is not a story, but it does contain stories if you listen without hallucinating. Real time didn't kill fundamentals. It placed a reflex atop analysis. 2 tracks in one brain. Long-term thesis humming under a short-term rhythm that could either carry positions to profit or drown them in noise. The modern market learned to live with both voices. The cultural shift spread beyond trading rooms. The public learned to expect the present on demand. Newspapers began printing late editions to catch the ticker's closing numbers. Salons and hotel lobbies installed machines as attractions. The soundtrack of commerce was no longer the bark of a floor broker, but the incessant chatter of a drum that never tired. Somewhere in the change, a subtler lesson took hold. Information is not just content, it is cadence. The faster it arrives, the more it feels like fate. When you watch a number update 20 times a minute, you begin to mistake motion for meaning, and yet sometimes the motion is the meaning. Businesses financed themselves differently because their stock now lived under a public microscope. Politicians learned that a stray sentence could scroll through hundreds of rooms and shift the cost of capital before they finished the paragraph. Lawyers studied whether a broken line was negligence or an act of God. Time became a liability to be managed. The ticker's legacy is easy to recognize on modern screens. Streaming quotes are digital paper tape. News feeds are the descendants of priority wires. Private networks are the old leased lines resurrected in glass and light, only faster and more exclusive. Algorithms are tape readers written in code, parsing not letters on ribbon, but microsecond patterns in electronic flow. Even the arguments feel familiar. One side says speed democratizes access and narrows spreads. The other says that speed is scarce by design and will always cluster in the hands of those who can buy a shorter path. Both are right. Tools that broaden access also concentrate advantage. Everyone can see something. Very few can see it first. The essential dynamics that emerged with telegraph and ticker still govern the present. Infrastructure is policy. Whoever owns the pipes decides who gets to live in the moment. If an investor wants to understand power in markets, the question to ask is not merely what the regulation says, but who runs the fiber, who controls the clock, who places the server nearest the matching engine, and who can get a technician out in the rain at midnight when a switch dies. Synchronization multiplies risk. A beautifully coordinated system is efficient until it is brittle. When everyone watches the same stream and learns the same reflexes, crowding becomes destiny. Efficiency and fragility share an apartment, and real-time changes behavior before it changes outcomes. The minute a trader watches motion, the motion begins to watch the trader. Feedback loops form. The messenger becomes a mirror. It's tempting to romanticize the old days, to imagine that when information moved slowly, wisdom had more time to form. Memory can be selective. Slowness protected the well-placed just as ruthlessly as speed protects the well-equipped. The telegraph did not invent unfairness. It simply shifted the field where advantage lived, from proximity to ports and political patrons, to proximity to wires and maintenance crews. But the new age introduced a different kind of psychological tax. Living in the minute is expensive. It demands a constant defense against overreaction, a posture of readiness that can turn into a posture of anxiety. The tape teaches vigilance. It also whispers urgency until urgency becomes habit. Markets learn to soften this with process. Risk limits, checklists, spacing between decisions, just as sailors learn to reef sails in rough weather. The machine forced professionalism because the cost of amateur hour became instantly visible. When panic hit, the wire could make it global. A cascade of selling did not need parallel rumors to spread. It had a single spine that carried the message to every room with a machine. At the same time, the wire enabled coordinated rescue. A banker could convene a consortium with messages that sprinted across town in seconds. A government could calm a region with a statement that rode the same circuits as the fear it contested. The tool amplified both sides of the human equation, the impulse to stampede and the resolve to steady the herd. That duality is why real time feels like a double-edged blade. The edge that cuts you is the same edge that can free you, depending on whose hand is steadier. The most enduring mythology the ticker created was the myth of the tape as an oracle. It encouraged believers to imagine that if they could stare long enough and attentively enough, the future would flicker in the sequence of prints. There is some truth there. Flow does reveal intent in fragments, but oracles are jealous gods. The more a crowd believes in a pattern, the more quickly that pattern erodes under its own popularity. The tape gives, the tape takes away. The lesson buried in a century and a half of experience is that real time is a tool for inference, not a license for certainty. The best listeners used it to measure pressure without worshiping it as prophecy. The other legacy is political. Whenever a society places its hopes and fears into a stream that updates every second, it grants enormous influence to those who maintain the stream. Private firms managed the wires, private firms rented the lines, private firms repaired the circuits. For long stretches, access to the present was not a public utility. It was a service sold to those who could afford it. The market's fairness was therefore not only a question of law, it was a question of uptime. The old elites learned to own the cables. The new elites learned to own the data centers. History does not repeat, but it often rhymes in cabling diagrams. There's a kind of romance in the image of a small crowd leaning over a pedestal in a storefront in 1905, listening to the little machine chatter and watching the ribbon spring to the floor. The romance is not in the promise of quick money. It is in the idea that the present itself could be printed, a thing you could hold, inspect, and argue with. Real time turned time into merchandise. It sold seconds and least minutes. It created new kinds of work, analysts of motion, engineers of synchronization, custodians of uptime, and new kinds of folly. It birthed villains and visionaries, and it rewarded those who understood that in a system defined by speed, patience still matters. The fastest trade in the world is not the best one if it follows a bad idea. In the end, what was born between the telegraph yes first whispers and the ticker as a relentless chatter was not merely a new machine, but a new expectation. The expectation that prices should arrive as quickly as thoughts, that markets should respond as swiftly as nerves, and that the present belongs to whoever builds the better wire. The expectation that a stream should be steady, that the second should be trustworthy, and that the system should confess its changes to us without delay. The expectation that the minute is the proper stage for money. That is why, decades later, the debates over priority access, colocation, and microsecond advantages are not a departure from history, but its continuation. The first leased line and the first premium relay were ancestors of the shortest fiber path and the warmest server rack. Technology promises democracy and delivers hierarchy, not because anyone conspired to fool the public, but because speed is scarce and scarcity always attracts price. The market turned scarcity into structure and structure into profit. It has always done so. The wire taught it how to do it faster. A final image lingers. The room is quiet except for the steady clatter of a drum. A clerk tears the tape and hands a strip to a client whose eyes scan the symbols like a gambler reading a last card. Outside, horses clatter and street vendors call. Inside, something stranger is happening. A city is watching itself think. A price set a street away arrives, as if from another world. Crisp, immediate, unimpeachable until the next print overwrites it. That's the birth of the real-time market. Not a parade of machines, but a reshaping of what a moment means and who gets to own it. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.